let's dive into some business tax returns in terms of reviewing, income calculation. So this is an 1120S, which stands for S Corporation. Up here, you're going to have your form number. So this is going to be, it could be 1120. So without the S, it would just be a regular corporation corporate tax return, 1120. It could be 1065, so 1065. That's typically a partnership return. So, more than one owner, there's partners. You can also have more than one owner, even in a corporation. So we'll go through this. I'll show you some different things to be on the lookout for as you are reviewing a business tax return. So I've redacted a lot of the information like the EIN number, the name of the business. But as you can see, this business was established in May of 2022 or 2022. So typically for businesses, you want to have a 2-year history. This was established in 22. We're now looking at tax returns for 2024. So that's the 2 years. We are actually in 2025. So that's even longer than the 2 years. So we've established the business history. That's fine. The business activity number, you don't really need this, but if you are not sure what type of business it is, sometimes this can give you some kind of indication. So you could Google this number or go to the IRS website to look at what does this business activity code stand for. I looked it up and it says other business support services. So it's kind of vague anyway. But sometimes they let you know that it's in the entertainment industry or real estate industry or some other profession, medical, where you can use this code to determine what kind of business it is. But otherwise, you would ask the customer, it would be on their loan application, etc. So right here, they have gross receipts of almost $8 million in gross receipts. And then they have here some kind of, deduction from their gross profits right here. So they have their gross receipts are almost 8 million, 7.8, right? And then cost of goods sold, they also have it at about 7.8 million. So they're already starting at a total loss of negative 19 or $19,000 in loss, or negative $19,000 in income. Line 7, I normally check that to see if they pay themselves. So compensation of officers, this is normally where they put the line, like if they give themselves a W-2 or they pay themselves a salary, that would be on this line and you can use that income. But we have nothing on that line. So we don't really look at the other deductions until we scroll down to depreciation or depletion. So these numbers right here, line 14 and 15, that is income that you can add back. Depreciation or depletion, they're not really expenses where people are, writing a check or paying cash for an expense. Depletion or depreciation is if you have some kind of item, so say you have a vehicle or a computer, you have supplies that you use all the time in your business, and as you're using them, they are depreciating in value. They are getting less and less in value because of wear and tear. You can write that off, but that's not an actual expense that you're writing a check to. So that's why we can add it back to the income. They call it a paper loss. And then there are other deductions. See statement 1. So we'll take a look at statement 1 in a second. Ordinary business loss is negative 166. So negative 166, 387. I'm going to add back this $12,000. It's not giving us much, but I'm going to add back. So I have 166, 387 plus the 12,000. Okay, so we have 178, 500 in loss. No, I'm sorry. What was I doing? Got to do the opposite. 166, 387 minus 112, 113. Okay, so we have total loss 154, 574. That's our total loss because I added this back, so it's less of a loss. We don't really see any figures on this next page. Now, this is our balance sheet on the tax returns. There's usually a few places I'm looking. Like I'm looking here where it says mortgages, notes, bonds payable in less than a year. This is blank, which is good. But if you do see something on this line, that means you're going to have to deduct that from the income because it's due in less than a year. These are debts that need to be paid. That's something that the underwriters are going to take a look at. Mortgage, notes, bonds payable in 1 year or more. you're okay. These are long-term debts. Then we're looking here, travel and entertainment, meals, things like that. This is something that you're going to actually deduct from the income, and that's typically because there's like a certain percentage that can be, like usually 50% of this is what they're putting on the line, so the underwriter knows, oh, there's another 50%. Normally it's meals. Since we're not exactly sure if this is meals, I'm going to go ahead and add that to the loss. I'm just going to add it just to be conservative. So now we're at a loss of 171, 144. Yeah, so this is the calculation of that cost of goods sold. Right here, we're looking at, I've kind of hidden the corporation's name and everything, but we are looking at, this is an individual and they own 100% of the business. So if you had the same company where you had multiple owners and your person, the person you're doing the loan for, they have a percentage that's 25% or less, then you wouldn't even need to look at these tax returns. You can show just this page to the underwriter. This is called their K1. You could say, hey, here's the K1. This is their name. It shows their percentage is only 18%, 20%. They don't own enough of the company to really make a difference. If your underwriter is, worried about this loss, then this is the loss that is going to count against them. So any other income that they were making is going to be offset by this loss. Now we had talked about statement 1, or I had mentioned statement 1. So I'm going to go ahead and just skip to that. Here we go. Here's all our statements. Okay, here's statement 1. And the reason I'm going to check here is to see if there's anything else that I need to add or subtract from the figure I already have. Auto and truck. That sounds like a legitimate expense. Bank charges, dues, home office allocated overhead. I don't know exactly what that is, but we're not going to do anything with it. Insurance, legal, meals. So see how in one section we were deducting meals because that was actually 50% where it's deducted here. So the underwriter just wants to make sure that we're actually using the entire deduction and not just 50%. So 16,570, that's the same figure we saw elsewhere of 16,570. The underwriter is going to just want to make sure that this times 2, the entire amount and not just 50%, is being deducted from their income. Office expense, software, these are all, looks like legitimate expenses that we can't really add back. So I have a total of 171, 144. If I were to divide that by 12, that's 14,262 in loss a month. So your underwriters are going to take what they already made and deduct this income to come up with the net income of what's left over and how we can qualify them. Or they may not use these tax returns at all if there's a loss. If they have, so say they have like a W-2 job. So say they have a W-2 job or they have another business. So they have a primary business. This is sort of a secondary business. So since it's not their main source of income, we may not bother with this loss at all. You may also determine that because of these tax returns, perhaps a different type of loan is what they need. So they can't really use these tax returns because it's going to report a $14,000 loss every month when we know that their gross receipts is almost $8 million. We may say, hey, Mr. and Mrs. Borrower, your tax returns show a loss because your accountant did a good job in making sure that you are minimizing your tax liability. No shade there. But in order for you to qualify the loan, let's look at perhaps a bank statement loan so that we can demonstrate, hey, you are grossing about $8 million a year. We'll prove that with your bank statements. And that way we don't have to look at your tax returns at all, or we don't have to provide those to the underwriter. We'll use that instead of using this type of way to verify your income. Another thing to double check is if this was a final return right here. If it was marked final, then this is the end of this business. It doesn't really exist anymore. And so this loss is irrelevant. Same thing on the K1. There's a part here where they can mark final K1. This is the final one. If they had marked amended K1, the underwriter may say, hey, I want to see the original and why was it amended? What changed? But if this final is marked, then all this loss stuff is irrelevant because this is the final tax return. This business is no longer going to exist. These are some things to kind of check out and reach out if you have any questions. Take care.